Hello everyone. Today we will answer these questions. What is theory of asset pricing all about and how does it work in practice? Asset pricing is fundamentally about linking the price of a security to its expected future payoff. Theoretical models like the capital asset pricing model and consumption-based asset pricing model aim to provide frameworks to estimate these prices. However, there are two opposing views in that field. First is from John Cruikshank in 2009, argues that prices are determined simply by the expected discounted payoff. And the second one is, on the other hand, critics highlight that the complexities of modern financial markets demand more nuanced models. So in this presentation, we have analyzed Procter & Gamble stock through KAPM, time series model, and compare theoretical insights with real-world performance. So let's dive into this model.
What is the capital asset pricing model? The CAMP model is focusing on the relationship between an asset's returns and market returns, quantified by beta. Our analysis of PG through a CAMP model reveals the information such as the PG beta is 0.5227. It indicates the moderate sensitivity to market movements. However, the R squared is only 23.6%. It means the CAMP explains less than a quarter of PG's return variance. It leaves a significant portion unexplained. Our next question will be, why does CAMP fall short? In real world, returns are often skewed and exhibit heavy tails as seen in PG's return distribution. The skewness here is only minus 1.75. It indicates more extreme negative returns, while kurtosis is only 47.10. It indicates frequent extreme events. As CAMP fails to account for such deviations, highlighting the need for multi-factor models like Fama-French three-factor model. Additionally, time-varying risk is ignoring in CAMP. Markets evolve, and so does an asset's beta. It makes dynamic models essential.
So let's move to our empirical results. The first, actual versus the predicted return. While our model captures the overall trends of PG's cumulative returns, it fails to predict short-term volatility. This highlights the model inability to fully incorporate external shocks or firm-specific factors. For example, during volatile periods like the 2008 financial crisis, there were significant deviation between actual and predicted return. Secondly, the stationarity test. Our ADF test showed that the PG's price data is non-stationary, while log returns are stationary, making them suitable for the time series analysis. Third is the critique of traditional model. As we have seen, the KAPM and similar traditional models struggle with the real-world complexity. They assume normality, ignore non-systematic risk, and fail to explain the behavior of shocks like PG, especially during extreme events. And this brings us to the importance of modern approaches.
So, if someone asks me what can we do to improve asset pricing models, these are my recommendations. Firstly, incorporating multi-factor model. The models like Fama French include additional factors like size and volume, which could better explain PG's return. Second is using volatility models. The volatility models like GARCH. These models handle clustering of volatility and can account for extreme events more effectively. The third recommendation can be exploring time varying beta. Since PG's market sensitivity changes over time, dynamic beta models are better suited to capture these shifts. And the last one is to incorporate macroeconomic factors. The factors such as interest rates, GDP, inflation could help explain the unexplained variance in PG's returns. In short, traditional models provide fundamental framework, but financial markets require more robust and flexible methodologies.
So, in conclusion, the theory of asset pricing is all about linking security prices to their expected pays off, while foundational models like KAPM provide a starting point. Their assumption often falls short in practice. Our analysis of PG demonstrate the need for modern approaches to account for real-world complexity. Thank you for your attention. We welcome any questions that you may have.